What would happen if America can't pay its debt? Imagine waking up to a headline so quiet, yet so deadly. The United States has missed a debt payment, not a recession, not a market crash, just a single Treasury bill that didn't get paid on time. In the first hour, banks freeze. In the first day, markets disappear. And within 48 hours, the entire global financial system begins to suffocate. Because when America can't pay its debt, even for a moment, the safest asset on earth becomes unsafe, and everything built on top of it starts to crumble. Welcome to the Financial Lens, where money, power, and history collide, and where small cracks often reveal the biggest truths. People always ask the same thing: what would happen if the U.S. defaults? But the deeper question is far more important. Why does the world care so much about America paying on time? Because the United States doesn't run out of dollars, it runs out of trust. And trust, not currency, is the real backbone of the global economy. To understand the stakes, you first need to understand what Treasury debt is. Treasuries aren't just government IOUs. They are the foundation beneath modern finance. They influence the interest on your mortgage. They guide the cost of your student loan. They support the value of your retirement savings. They determine how companies borrow money, how banks measure stability, and how nations trade with one another. They are the invisible architecture of the global economy, the quiet mechanism that keeps money flowing, credit working, and markets believing. If treasuries ever lose credibility, the structure above them does not slowly weaken. It violently shakes. Because here's the truth. The world doesn't run on dollars, it runs on confidence, and confidence is fragile. Go back to 1790. The United States was young, exhausted, and buried in war loans. Many nations in history defaulted at this exact moment, but America did the opposite. Treasury Secretary Alexander Hamilton made a radical proposal: pay every dollar, honor every debt, and keep borrowing. His idea was simple. If America proved it was trustworthy, investors around the world would trust it with their money. And they did. European financiers bought American bonds. Confidence grew, credit flowed, and a small, fragile republic discovered the secret that would shape its future. Debt wasn't a burden. Debt was leverage. Every major chapter of American growth, industrial expansion, the railroads, the New Deal, World War II, was financed by borrowing. Confidence made credit, credit made power. Then came 1944, Bretton Woods, a moment that reshaped the world. 44 nations gathered to build a new economic order after World War II. They needed stability. They needed an anchor. They chose the US dollar backed by gold, and they chose it for a simple reason. After the war, the United States held 2/3 of the world's official gold reserves and half of global industrial output. Its institutions were stable, its economy was dominant, and its debt had never been questioned. The dollar became the center of the financial universe. American treasuries became the safest place on earth to store wealth. And the U.S. became the world's financial core. But the system they created had a weakness buried inside it, a weakness that would emerge a generation later. By the late 1960s, America was spending more dollars overseas than it had gold to redeem Vietnam. Social programs, Cold War commitments. Foreign nations began demanding gold instead of paper. The U.S. was losing the metal that gave its currency strength. So in 1971, President Richard Nixon made the most consequential financial decision of the 20th century. He ended the dollar's link to gold. Overnight, money floated freely. Its value no longer came from metal, it came from belief. Not gold, not reserves, not commodities, just trust. This moment created a new global architecture, the debt standard, a world where the stability of everything depends on the credibility of U.S. government debt. America gained a superpower. It could issue almost limitless credit. But the world gained a weakness. It now depended on one borrower. Most people imagine the national debt as something that needs to be paid off. But that's not how this system works. America doesn't eliminate its debt, it renews it. When a bond matures, a new one replaces it. When interest is due, new bonds help pay it. Money flows in a cycle that never truly ends. This is normal as long as the cycle continues. The danger comes when anything interrupts that cycle. One glitch, one political fight, one miscalculation, and the entire structure shakes. We know this because it has already happened. In 1979, a simple computer error delayed $120 million in Treasury payments. It was only a processing mistake, nothing more. But the reaction was immediate. Interest rates jumped sharply, investors panicked, confidence fractured, and the effects lingered for months. A tiny error proved the system's vulnerability. Then, in 2011, Congress nearly let the U.S. default during a debt ceiling fight. Not because the money wasn't there, but because politics got in the way. For the first time ever, the U.S. lost its AAA credit rating. Global markets lost over $2 trillion in weeks. Today, the cracks are quieter, but more serious. Debt has surpassed $38 trillion. Annual interest payments approach $1 trillion. Foreign nations are reducing their Treasury holdings, central banks are buying more gold, and countries like Brazil, Russia, and India are building small trade systems that bypass the dollar. None of this signals collapse, but it all signals doubt, and faith doesn't collapse all at once. It erodes slowly. If tiny cracks can shake the world, what happens when the whole foundation breaks? This is the moment nobody wants to imagine, but everyone needs to understand. In the very first hour, a subtle but historic shift takes place. Treasuries, long treated as the safest asset on earth, suddenly lose their halo of absolute certainty. It doesn't happen with fanfare. It happens quietly in the algorithms that price risk, in the models that measure stability, and in the minds of the people who keep global finance moving. Banks feel it immediately. The collateral they rely on every minute of every day is no longer unquestionable. And when banks doubt their collateral, they stop lending, not out of panic, but out of instinct. The machine of global finance begins to tighten. Transactions slow, money hesitates, and markets that normally hum with constant movement fall unnaturally still. The system hasn't collapsed yet, but like a heart that suddenly skips a beat, something feels wrong. By the sixth hour, the outside world begins to feel what the financial world already knows. Foreign central banks start repositioning themselves, not loudly, but urgently. The dollar, once the universal refuge, begins to slip. Investors, sensing uncertainty, seek shelter anywhere they can find it, in gold, in the euro, in the yen. Even in digital assets that promise nothing except that they are not the dollar. Interest rates spike as lenders demand protection, and that spike begins to choke the real economy. A family looking to buy a home suddenly finds the cost of borrowing surging beyond reach. A business hoping to expand sees its credit lines dry up. The gears of daily economic life begin to grind slowly, then sharply, toward a halt. Credit, the quiet force that keeps everything moving, simply stops flowing. By the end of the first day, the consequences are no longer hidden inside financial plumbing. They reach the government itself. The United States, usually able to borrow at any time for any reason, finds that the world no longer extends that privilege. And without the ability to borrow, the federal government can't function. Payments that millions depend on begin to stall. Military salaries pause. Social security checks are delayed. Hospitals wait for reimbursements that do not arrive. Federal systems that usually run like clockwork begin to flicker and slow. Confidence, once America's greatest asset, begins to evaporate. Within a week, the shock escapes the borders of the United States and spreads across the planet. Pension funds from Europe to Asia see the value of their safest holdings decline. Banks everywhere scramble for liquidity because the collateral they trusted is no longer unquestionable. International trade deals begin to strain under the pressure of uncertainty, as buyers and sellers hesitate to price goods in a currency whose future suddenly feels unstable. Nations don't move away from the dollar out of defiance. They move away because survival demands it. This isn't a recession. It isn't even a crisis in the traditional sense. It is something far more dangerous. A financial system without a foundation. A world built on trust facing the moment that trust disappears. But the biggest danger isn't collapse, it's replacement. If America defaults, China won't simply step in. Europe won't replace the dollar overnight. No currency could. Trust takes decades to build, a moment to lose, and generations to rebuild. Instead of a new world order, we enter a period of global friction. Every loan becomes riskier, every trade becomes slower, every currency becomes weaker. It's not the fall of America, it's the rise of uncertainty. And uncertainty is poison to the financial system. A U.S. default wouldn't be caused by bankruptcy. It would be caused by politics, by gridlock, by brinkmanship, by dysfunction. America has unlimited dollars, but not unlimited unity. And confidence doesn't care why the check bounced. It only cares that it did. Rome learned this. Britain learned this. Every empire learns this. The U.S. is not immune. So what would really happen if America can't pay its debt? Here is the truth. It wouldn't just break the financial system, it would break the story the world believes in. Because the global economy doesn't run on money, it runs on meaning, on trust, on the belief that the center will hold. And if that belief dies, nothing replaces it quickly. The world doesn't run on dollars, it runs on faith. And faith is the one currency no nation can print. If this gave you a new perspective, subscribe. History has the answers. And here on the Financial Lens, I'll show you where to look.